You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Thanks for tuning in to Mining Stock Education. I'm your host, Bill Powers, and today's episode will be unique, hopefully for several reasons, but for sure for at least one reason, in that Bill Powers, the host of Mining Stock Education, will be interviewing a guest that also goes by the name Bill Powers. I'm speaking to Bill Powers, who is a private investor, an independent analyst. He's the former editor of the Powers Energy Investor, the Canadian Energy Viewpoint, and the US Energy Investor. Bill has published investment research on the oil and gas industry since 2002. His website is bill-powers.com, and you can also follow him on Twitter, which I would encourage you to do by going to the handle @BillPowers1970 on Twitter, @BillPowers1970 on Twitter. So Bill, welcome to Mining Stock Education, and let me just start it off with asking you, how does it feel to be interviewed by somebody with your name?
It's great to be here, and certainly looking forward to our discussion today.
Yes, and I should say that over the years, when I've sometimes requested interviews with certain guests, then they bring up, "Hey, Bill, it's good to hear from you, and what's your views on the oil markets?" And then I would politely write back and said, "I'm a different Bill Powers, and this is my show." Let's start off with your overall macro perspective on the oil markets. You're an energy analyst. Break it down from a 30,000-foot level. What should we be looking at and understanding in the oil market today?
Well, really, we're in an unprecedented time, and I know that is an overused cliche, but we've never seen the rig count decline in the United States at the rate it has over the last 3 months. We've never seen production for U.S. oil fall at the rate it's been falling, and or oil trade the way it has been at up to negative $30-something at one point. And storage is certainly at a high level, but the production has gone from over 13 million barrels to about 11.5 in the United States. A lot of that has been a decline from numerous shale fields around the United States, and that looks to continue over the rest of the summer, and prices have certainly rebounded and are looking to be quite volatile, but it looks like supply destruction is certainly, we're seeing a lot of it right now.
Crude, as we speak, is at about $34 per barrel. Is there any hope for the U.S. and Canadian shale market, which produces oil above that cost?
Well, I think there certainly is. We've seen the rate at which production is going down from the shut-ins, from the lack of drilling. Remember, a lot of these shale fields are declining at a natural rate of over 40%. So just the lack of drilling will rebalance the market within 6 to 9 months, and that could be above the cost of production. I also think that companies will be very, very slow to ramp up activity irrespective of where prices go, at least for the rest of this year. So I think the discipline that has been sorely lacking for much of the last 15 years in the North American oil market is starting to emerge, and I think it's going to create a healthier industry with players who are not so indebted that it seems as though they can't make money at any price, and the market will certainly rebalance itself like it always has.
On the demand side for oil, that's of course going to be determined by what this economic recovery in the States where you and I reside, but also around the world, what that looks like. Do you have any thoughts to share on the demand side for oil?
Well, it's certainly rebounding. Just from, I live outside of Chicago, and we are certainly seeing traffic pick up. More flights coming in and out of O'Hare. So there is a stimulus that is happening. It's going to happen on the fiscal side throughout the United States. So I do think we are going to see a rebound in demand, as well as a real structural changing of the U.S. economy that will will accelerate manufacturing returning to our shores. and that will certainly be good for demand. And I think it's something where there's a lot of political will to increase our industrial activity.
A previous guest on this show is Steve St. Angelo from SRSRoccoReport.com, and Steve has shared his thesis, his theory about energy returned on energy invested, and that when it comes to oil, it's taking the industry more energy inputted in order to pull a barrel of oil out of the ground. Do you have any thoughts on Steve's theory? Are you in agreement with it, or what points of disagreement would you have?
Well, he's certainly correct in that sense that the cost of production and the amount of energy that goes into the ground to produce a barrel of oil is certainly rising, and it's going to continue to rise. We have seen a number of U.S. shale oil fields already have their best locations drilled and are already into decline. And that's something that is to drill the remaining locations. They're not going to be as prolific, and the costs are certainly going to go up. And this is true around the world, whether it's offshore, Gulf of Mexico, Brazil, Russia, pretty much everywhere. The costs are going to go up, and they'll be at different levels in different areas of the world, but certainly it's going to become more and more expensive to extract oil.
What's your thoughts on the peak oil theory?
Well, we certainly are seeing with the U.S. Production is down, and that is only a recent event. But it looks like with the level of spending we're seeing right now around the world, we're going to see production decline probably the rest of this year, and it will continue to decline until prices get high enough and activity picks up. But more importantly, the number of locations that are remaining in the United States that are prospective, that will be economic at today's levels is very, very few. So prices will have to go up significantly for activity to rebound. And that also is something we're seeing, whether we have peak oil now or whether it's down the road some. But we're going to see the peak in a lot of things. And one of the things we're certainly seeing is peak gold. Gold is, we've had 7 consecutive quarters of declining gold production, according to the World Gold Council. And this is something that where the reserves are being produced and they're just not being found. And it's the same thing we're seeing in oil, where the world produces around 30 billion barrels a year and doesn't find anywhere close to that. So whether it's this year, next year, it's just doing the math that the peak is coming.
Don't you think the free market and human ingenuity, though, could solve that? To where, yes, the gold price would go up or the price of oil would go up, and that would also incentivize new ways to find and recover out of the ground these resources.
Well, to a certain degree, there will be some incremental innovation that will maybe make extraction a little bit cheaper, but the rate of finding the new discoveries is really what we have to look at. And whether it's gold, whether it's oil, or many other minerals, the rate at which we're finding it has been dropping for 10, 15 years in some cases, and this really leads to the fact that there is a limited a rate at which it will come out of the ground, and there's a good chance we're near or at or past that peak already.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of high-grade copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion, with a 33% internal rate of return. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well-capitalized, has no debt, and possesses strong institutional support. Trilogy trades in New York and Toronto under the ticker TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com. How does the U.S. dollar relate in your view with oil recovering? Gold has been on a tear. How does the U.S. dollar come into play?
Well, I'm very bearish on the U.S. dollar. I believe that while the U.S. has helped its trade deficit in recent years through the increase of domestic energy production, we have not seen the dollar break out much past 101, despite seeing a 34% decline in U.S. equities in the first quarter. We've seen basically a flat trading range for the last few years, almost 5 years now, and we've seen foreigners really sell U.S. treasuries, U.S. stocks, corporate bonds, real estate. There is massive selling by foreigners of the U.S. dollar. So and there's a lot of government bonds, U.S. government bonds being issued that seems to be overwhelming demand. So I'm not bullish on the U.S. dollar. I think it can go a lot lower, and this is very, very bullish for oil and pretty much every other commodity.
We may see inflation, but one argument would be we're not going to see hyperinflation in the States until other nations no longer use the U.S. dollar as their reserve currency or need it to buy oil. How do you engage that thought?
Well, I certainly think the appetite for U.S. involvement in overseas wars is certainly waned in the last decade, and the other countries are also seeing, such as Russia, has now made it very clear that they are looking to alternatives for the dollar. And certainly China is also. So I think an alternative, or at least less reliance on the dollar, you're seeing many countries ramp up their reserves of gold in their central banks. And whether hyperinflation, I can certainly see it. One of the things that I would encourage everybody to do would be to read about the interwar period in Germany. That is a fascinating period of when both Germany and Austria went into a hyperinflation and what it did to society. We see much of that happening right now. So it is a confidence game, and the U.S. is certainly has abused the trust that other countries have put into it. Really since 1971 when it closed the gold window. So whether it's hyperinflation or a very high rate of inflation or whether it's stagflation, those are all very likely scenarios. And so inflation is going to pick up, and it's going to be what many would call not the good kind of inflation.
You also, as an energy analyst, focus on LNG, liquefied natural gas. I have a chart before me I just pulled up, and looks like for about the last 2 years almost, there's been a steady downward trend. What should investors know about this sector right now?
There's really a lot that's happening in the LNG market. There's some countries that are seeing declining production of or exports of LNG, such as Oman and some other countries in the Middle East. But for the United States, LNG is a very controversial subject. As you probably know, for a long time, the U.S. was a net importer of LNG. And in 2012, I published a book called Cold, Hungry, and in the Dark that really challenged a lot of the assumptions about how much shale gas there was in the United States. And the projections of U.S. total reserves that were made by academia, the industry, as well as the U.S. government have proven to be very, very wrong. However, what we have seen is a flood of gas produced from the different shale basins, especially the Marcellus. And most of these wells have been uneconomic. So while the U.S. has become an exporter of LNG, I don't expect that to last, for too many more years, simply because the U.S. Shale gas reserves are grossly overstated, and there is increasing domestic demand for natural gas, and the overseas markets are very weak right now. So I think it's a very difficult subject to wrap your arms around, because there's a lot of what I would say disinformation about the U.S. long-term potential to export natural gas.
Under President Trump's America First policy, the U.S. Department of Energy has been looking at natural resources and critical metals and assessing whether we are reliant on potentially hostile nations for the functioning of our nation. And how does liquefied natural gas and oil come into play? President Trump announced that he bought, when the oil price went down, he bought a lot of crude oil for the nation's reserves. But as a fellow U.S. citizen, what are your thoughts here?
Well, I think that is more of an effort to manipulate markets than it is to really change much of anything. And part of it, I think, was really a bailout for much of the energy industry, in the sense that there wasn't much storage available, so they bought it and kind of left it in the ground for the most part. But really, the U.S. has used, both under Trump and Obama, the threat of diminishing Russia's importance on the world stage through the export of LNG to Europe. And that is something that is really hard to understand, since Germany and pretty much every other European country is very reliant on exports or imports from Russia. And Germany has only one LNG import facility. So the practicality of a great deal of exports going to Europe is quite small, and they've had a long-term relationship with both in Soviet age times. There were West Germany imported a lot of gas from Russia, and much of Europe is becoming increasingly dependent on Russia. So I think politically it's very difficult, and even still, even when the U.S. was at its peak of oil production, we weren't much of an exporter of oil. We consume 18 million barrels a day approximately, and produced around 13 million. So while some blends of crude there wasn't much demand for, and we were able to send overseas, or certain products we were able to send overseas, we weren't really able to impact the world oil market to any meaningful degree. And I think our importance as an energy exporter is going to go down in the future.
Are you bullish on uranium? Uranium's perked up a little this year. It's at $34 per pound. What are your thoughts about uranium?
Well, I certainly think that the uranium has a very bright future. According to the U.S. Department of Energy, last year, the U.S. produced more kilowatts from its nuclear plants than any other year in history. So it is certainly something that the U.S. government has made a commitment to, in helping restart uranium production in the United States. I do think that uranium is going to be is breaking out into a bull market. I don't know. There's many other people who follow it more closely than I do, but demand is growing. You've seen some significant market discipline from the Kazakhstan producers, as well as Cameco. So this is really what you want to see in any resource market, is the most important players cutting back production, acting as good stewards of for their shareholders, and not overproducing or driving the price down further, and increasing demand from both the United States as well as overseas countries, where China and India and other countries are having plants that are coming online. And so I do think that we will see a renaissance in the nuclear energy industry, and I think it'd be a very meaningful one.
Bill, you're an energy expert, but you're also a private investor and a contrarian. So for the investors listening to us, in light of what we've talked about thus far, are there any investing ideas that you could share with us?
Certainly. Two that I have really fallen out of favor. If we look at Peyto Energy in Canada, and it's a natural gas producer in the Sundance area, and it's really has been a company that is Canada's lowest cost producer of natural gas. It's had a 20-year history, very strong management. It's been through ups and downs. and the stock is in the $2.50 range, and this is well over 90% off of its high, and a really sound fundamental business. The other one for really contrarian investors that can see a meaningful, that would like a little bigger company and very strong management, where an executive chairman of Murray Edwards is Canadian Natural Resources. This is a company that is the largest producer of natural gas in Canada, has oil sands, and it's really a business that has made it through the other side of a really horrific period in Canadian energy history.
I follow neither of those companies, so would the primary catalyst for a rising share price for those potential investments be a rising natural gas price, or is there something internal within the company that could catalyze the share price?
Really, it's going to be, these companies, along with pretty much most of everybody else in the energy patch, is going to need higher prices.
So it's a call option on LNG, essentially?
Or actually more on oil and gas production is really what where this is a call option on. And it's kind of like when you coming out of, for your, in the precious metals industry, the companies that have, the big companies that were able to make it through the bear market have rebounded first, and I think these will be two of the first companies to rebound materially once we start to see higher prices and in interest in the industry.
You also invest in gold, Bill, so how are you navigating the gold sector? We focus a lot on that in this show.
Yes, I certainly have been a long-time investor in both bullion and in mining companies. Big fan of silver at this time, and I'm been a long-time investor in three companies that I can share with you today.
Please do.
Pan American Silver, obviously, Ross Beatty, I think, has done a great job with building the company. Huge reserves per share, a couple catalysts that I think will really make that will really increase shareholder value over the next few years, especially a rising silver price, but absolute top-notch management team and excellent cash flow, even in a low silver price environment. The other one has been more of a struggle. My second idea has been more of a struggle, but I think we're seeing some turnaround, and that's McEwen Mining. Rob McEwen, as most of your listeners probably know, was involved in Goldcorp and seeing that work out. I've been investing in McEwen Mining since Minera Andes, and so I've been involved for a long time and seen it go up and down. But just recently it was announced that Rob bought 2 million shares in the open market, which is about 0.5% of the outstanding shares of the company. They have some interesting projects in Canada, Mexico, the United States, and Argentina, and I think that they've had a very difficult go of it recently, but things seem to be moving in the right direction, and especially at today's prices, I think it'll have the wind at its back.
And Bill, a question on that. Is that essentially for you, how we talk about you're betting on the horse, the project, or the properties, or you're betting on the jockey? For you, would this be betting on the jockey?
This is absolutely betting on the jockey. I own a company that was acquired by U.S. Gold before it became McEwen Mining. And I've talked with Rob at numerous times, one-on-one. I've met him at a conference a couple times, and always one of the straightest shooters you're ever going to find. I'm a real big believer in getting rid of the agency problem, which is something we see in resource companies all the time, where the management has a different agenda than the outside shareholders. Rob does not take a salary. He is a excellent steward of his own of his own company. And even though they've had some missteps, I think he is only going to make money if shareholders make money. And that's something that I really, really like to see. And that's why I've stuck with it. And I think it's going to have a great rest of the year and going forward, some very exciting projects. And the third idea is something that here again, this is a betting on the jockey, and it's a company called Chesapeake Gold. It's a company run by a gentleman named Randy Rifle, who was on the board at Goldcorp. Still, he made the Penasquito discovery in Mexico and has discovered a very large deposit of silver and zinc in Mexico called the Metats Project. And this is recently, there was a large funding done through Eric Sprott to help them buy out the company. There was a net smelter royalty on their project that they were able to buy back from Silver Wheaton, I believe, or I think it's now called Wheaton Metals. And the other, one of the founders of the company is a very interesting story, is a gentleman by the name of Peter Palmetto of Sun Valley Gold. And Peter was gotten involved in some early stage companies. And he made a lot of money in the 1987 crash through put options, and retired to Sun Valley, Idaho, and started numerous gold companies. And this is one of the ones he backed. Randy Rifle, who is the largest shareholder of Chesapeake Gold, or I think he's now one of the top few behind Eric Sprott. And this is a huge deposit, and it's one that is near infrastructure. And I think it has the company has a very bright future, and it's under the radar screen of pretty much everybody.
I met with Randy at the 2018 Beaver Creek Precious Metals Summit, and I remember at that time that he said they were waiting on higher gold prices. So they have gotten higher gold prices, probably by about $500 an ounce since I last chatted and really took a look at the company. But in your portfolio and your investment thesis, you mentioned it was a bet on management, but would it also be essentially a call option on the price of gold? Because these big projects, they don't move forward unless it's in a good gold bull market.
And that's absolutely correct. And this is Metats is certainly a project that will be wildly profitable at higher silver prices, and it's it is a meaningful project that will get looked at by companies like Teck and Vale and really large companies that will where it can move the needle for them. And so you've seen a number of companies where they've had good drill results, and this is they've also worked on a number of satellite projects that I think are very exciting. And there's a lot of upside for the shareholders. They're very well capitalized. They did not need to raise money during the downturn at unfavorable prices. And you see, management is certainly aligned with shareholders on this one. And it's great to see Eric Sprott get involved to the degree he did. And I think this is one that will gain a lot of attention as the M&A wave starts to pick up. And a very exciting story there.
The best way to follow Bill online is to follow him on Twitter, and his handle again is Bill Powers 1970, Bill Powers 1970. If you're not on Twitter, you can also look Bill up at his website, bill-powers.com. Bill, I really appreciate you coming on the show today and sharing your insights. Thanks for joining me today.
It was great being here. Thanks so much.